Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week um, on a much more bearish tone here after yesterday's trading session. I would say the overall sentiment was pretty sour going into the start of the week after the weekend, um, call it AI disruption report that came out that painted a pretty dystopian picture of what our reality and economy could look like a couple of years out after AI is adopted throughout the economy. There were a few different scenarios that painted like I said, a pretty dystopian future that, as even the publishers put it, is just a possibility, not what they're considering necessarily as probable. That it was simply just a thought experiment as to what could happen. But nevertheless, investors got quite spooked as a result of it. And we saw some pretty broad selling yesterday as a result of it. We saw everything from, IBM getting down, down 13%, and that was specifically on the back of Claude Code announcing that they could potentially automate COBOL modernization, if anyone doesn't know what that is, but a lot of mainframe computers still power some really important financial services on those specific languages on IBM computers. Even the code that processes your stock and options trading, some of them are still built on really old infrastructure and coding. And there actually aren't a lot of those coders around. And the idea of modernizing that using AI was really what sent the stock down substantially. IBM had its worst day since October 2000. We're really going back to the dot-com boom to find days that were worse for IBM. So the market is overall quite concerned around disruption. Anything else around software and payments and consulting, we saw, selling across the board, CrowdStrike down 10%, American Express down 7, Visa and MasterCard down 4 to 5%. You have quite a few other software stocks down 5 to 10%. Microsoft got hit even further despite being sold off pretty heavily already. And gold continued to rip higher here. And despite all of that, Bitcoin continues to fall and continue to collapse. So, going into this morning's trading session, and not to mention the tariffs, confusion over what's going to happen with regards to tariffs, what is going to be the blanket rate that's going to be applied across the board. Over the weekend, President Trump suggested that was going to be a 15% tariff applied across the board. But what we saw take place yesterday was actually a 10% rate. So there was a lot of confusion around whether it was going to be 10% or 15%. It seems like right now it's confirmed that it'll be a 10%, not the 15% that was announced over the weekend by President Trump, which, the net effect to almost all countries is a significant reduction in tariffs. So overall, that's going to be a net positive here for the markets to have a lower tariff rate. However, I don't particularly see that that's just going to be the end of the story. Likely, there's going to be more creative ways to put on tariffs. So that's going to likely lead to some volatility down the future. I will say overall, tariffs have generated a lot of volatility in the markets over the last year, but overall, the net result has been the fact that the market largely has shrugged them off. And I think this will be the same. But, again, a 10 to 15% blanket rate on tariffs is still going to be a reduction in many cases for where they are versus where they are today. And that theoretically should be a net positive here, minus, the uncertainty that we're likely going to still have with this. Um, just a couple of weeks ago, Meta announced a major deal with NVIDIA, that spanned a substantial amount of spend with NVIDIA to build out using their GPUs. But there was recently just an announcement that that AMD also signed a similar deal with Meta. So this is, the first hyperscaler explicitly running a dual GPU strategy at a massive scale. And it kind of validates the thesis that the landscape for AI compute is starting to evolve away from a single vendor that largely has been driving this, which is NVIDIA. NVIDIA chips have been predominantly used for training purposes, but as these hyperscalers' needs change more towards inference compute, and how that's going to scale, it's interesting to see how that strategy is going to evolve away from a single vendor strategy, which is up until now predominantly only benefited NVIDIA into, now you have a handful of competitors in this particular space: Amazon, Alphabet, AMD, all supply chips that provide specific inference compute needs. And that's going to start eating away into NVIDIA's margins as we look at the future of AI. So there's a lot happening in the world of AI these days and how that's going to impact the broader markets here. And speaking of broader markets, you have the S&P 500, which again, for many, many months now has essentially flat. We're basically still at the same levels that we were in late October. The S&P is kind of in between the 680 and 700 level here on the S&P 500. We continue to see 680 as a major support level that so far continues to hold. If we break below 680, we really see 650 as kind of the next downside target. And really at this stage, the biggest concern from investors right now is really how big of a disruption is AI going to have on the broader markets. And the report that came out over the weekend really gave investors a look at just how broad that impact could be outside of the obvious places that AI will replace. Over the last month and a half, the concerns around AI were twofold. One are the hyperscalers like Amazon, Microsoft, Alphabet spending too much capital expenditure to ever make that back in terms of the investment that they're making. Are they ever going to make enough revenue to justify the investment they're making? I think that while most investors in Wall Street are on the fence about that, the potential outcome of that is pretty clear. Just the question, and I think if you just go back to the internet being kind of the parallel example here, I think at this stage we can't even imagine how big AI is going to be, the same way we couldn't imagine how big the internet was going to be, back in 1996, 1997. But that doesn't mean the road to that phenomenal, spectacular growth isn't littered with a lot of volatility and pain. So I think it's important to recognize the long-term opportunities while still being conscious of, the road ahead could be incredibly bumpy and volatile. On the flip side, you have, some obvious plays where the AI is going to disrupt existing businesses. And kind of the most obvious places that people are focused on right now are software related stocks. Um, those are kind of your obvious places, but it's starting to look that much broader impact is starting to take fold as well and started to take hold. And I think that's really important to take a look at here. But before we jump into some of those individual names, right? Um, if you look at kind of the rotation that continues to happen, and this is one of the most durable rotations we've seen in quite some time now. Um, let's see. How do I don't know why. I'm having trouble removing my lines. Give me 1 second. There we go. What I was saying is that despite that the S&P has been moving relatively nowhere, the rest of the market continues to outperform. We see that across small caps. We see that across the equal weight S&P 500 index. If you look at RSP, you also see it in global indices. You see it in international indices. So, for example, if you look at VWO, which is Vanguard's world ETF, if you look at Europe, you look at Asia, you look at pretty much all non-domestic equities, it's outperforming the S&P and the Nasdaq. And that is largely because tech, which has been driving gains in the equity markets for a decade plus, and certainly the primary driver of equities over the last 3 years, has really underperformed, and tech has an outsized weight on those specific major indices. So the net result is that the S&P and the Nasdaq look like they're not moving very much, and the reality is that the rest of the market is moving. It's just that tech has been pulling back enough that has pulled back enough that has completely negated any gains that the rest of the market has. So it's really important to understand this rotation that continues to happen underneath the surface as you're positioning for this market. There are potentially some early signs that tech is showing a little bit of life here, but I think as of this morning, I think that that rotation continues to remain in the favor of the rest of the market and not in favor of tech. Um, and Until tech starts to show better stability, I don't particularly think now is the time to be so heavily invested in tech, with the exception of some select opportunities within AI. I think the overall tech industry is at the moment still a place where the performance is just not there. So, a few names that I think are worth paying attention to here right now. First one I want to take a look at here is JP Morgan. JP Morgan yesterday, and this is part of the broad selling that we're starting to see here, right? This is a stock that kind of got to that $300 level back here in, call it late July, early August of last year, where we saw that. Um, hmm, I don't know why my drawing tools are not working so well here today. Um, hmm, Oops. All right, let me try one other thing here. So this was the level I was referring to. As you can see, this $300 level here. JP Morgan got to this level back here in late July, early August of last year. And since then, that's been an important level between support and resistance for quite some time. And just yesterday, we started to break back below this major support level here on pretty significant volume here as well. And that's really kind of where there's cracks starting to show, not just in the software space, but the broader economy. And JP Morgan certainly represents, the outlook of what, the higher income consumer represents to some degree. You can use it as a proxy for the health of the US consumer in JP Morgan, since they generally service a higher income consumer. And 70% of the US economy is consumer spending. And at this stage, 70% of that consumer spending is coming from a smaller percentage of higher income cohort. And that cohort is what JP Morgan to some degree represents as a proxy for. And we're starting to see some cracks show in that specific, what has been until now a fairly bulletproof institution. And AI is starting to show some signs of potential disruption for, this segment of consumer spenders. So I think this is one that's really worth paying attention to right now in terms of the concerns around how AI is going to disrupt the market is spreading beyond just software into just the broader general economy. Um, this is not saying that, or rather, I think the best way to summarize it is that the charts right now don't show an overly major concern, but we are on the verge of potentially breaking below a major support level and showing some bigger concerns. So I think that's why JP Morgan is worth paying attention to right now as investors to get a better sense for how the outlook of equity sentiment or the economy will shift over the next few days, few weeks, and few months using stocks like JP Morgan as sort of your barometer for that. On the flip side, if you look at tech, Microsoft certainly sold off pretty heavily, and now we're continuing to see Microsoft trade near what is now, um, a fairly compelling price level from a technical perspective, right? You have a stock that has had this double top up here in that 550 range. I'm sorry. Didn't mean to reset that, but you had that double top here at that 550 level on Microsoft. Since it traded at that double top, the stock has continued to tumble pretty substantially here, and now we're kind of back to some major support levels here, going back to April of last year. Basically, if you think about the tantrum that the markets threw after the initial tariff sell-off, that's where Microsoft traded all the way down to, is this 380 area. That's where we're trading all the way down to. And there are certainly some signs that the markets are starting to get exhausted and that you are setting up for a potential what you would call a counter trend bounce. So Microsoft trading at valuation levels that we haven't really seen in a long time, around 23 times forward earnings, starts to look quite compelling here. And a lot of traders will look at this chart and say, no way, that sounds like you're trying to catch a falling knife here. But I think you have to, in these types of environments, think a little bit contrarian, think a little bit counter to what could be some panic selling here at the moment, and that creates opportunity. We all know the old adage of buy low, sell high. Well, it sounds simple enough in terms of how to make money in the markets, but buying low means buying when no one else wants to buy. And that's exactly what Microsoft represents here right now. The other one I want to take a look at here is Alphabet. Alphabet has been trading sideways here for a little bit here as well. As you can see, the stock has been sort of sideways in between 300 and call it close to 325, 330 here to the upside. That's really kind of where we see some potential opportunities here as the stock trades sideways. If it breaks below 300, that's really where we would look at changing our outlook in the short run for Alphabet. But in the meantime, our upside opportunity, I think, represents similar to what we've seen in terms of Meta. Meta just announced that deal with AMD. We're seeing AMD up about 10% as a result of that announcement. Meta, interestingly enough, also trades at a very reasonable valuation for one of the hyperscalers. Um, and I think given the recent sell-off here into that 630 level also represents a really interesting opportunity here for investors at the moment. Outside of that, I think there's quite a few other um, interesting opportunities right now in the broader markets. Um, If you look at sort of the Lowe's Home Depot type trade, both of those stocks have recently pulled back a little bit here from their recent highs. Lowe's, as you can see, pulled back into that 270 level here. That was the recent breakout that we saw here, traded all the way up to 290, now pulled all the way back to 270, and now represents, in my opinion, some upside opportunity from where we are right now back into that 290 range. Lowe's trades at a much more reasonable valuation relative to Home Depot, and I think is an interesting play here at the moment. Mm. You have seen some of the other um, housing stocks like Pulte Group, the home builder. They focus more upscale builds, and so far has held up quite well in this volatility here over the last few days. Continues to push towards 52-week highs. It actually just made a new 52-week high a few days ago, pulling back a little bit here, and that really presents the opportunity for some upside here as well for Pulte Group. But you see it across kind of the housing, home builder stocks overall. We have CME, the Chicago Mercantile Exchange. This is where all of your futures and treasury bonds are traded. And as we kind of have this volatility here, this volatility has generated the upside opportunity for the exchanges. And what's really interesting about CME is that CME is far more profitable than its peers. Net profit margins for CME, is greater than 50%. So as the world gets uncertain and as we see a lot more volatility, the exchanges like CME are the ones that benefit from that volatility, and we're seeing it in that price action right now as things get more uncertainty. As things get more uncertain, CME continues to power higher. We see that kind of across the board on some of the exchanges, whether you look at Intercontinental Exchange, whether you look at NASDAQ. But NASDAQ is another one that I think is worth taking a look at outside of CME, that's taking advantage of this. But CME is really the main beneficiary of the current volatility that we're seeing. And I'll leave you with one other stock that I think is worth paying attention to, Motorola Solutions. Not really on a lot of people's radars. Motorola Solutions no longer is the phone maker of its heyday. They're focusing predominantly on enterprise devices, specifically body cams, security communication devices, which is really just another way of saying walkie-talkies for military and security applications. So communications across those types of solutions and body cams, potentially even into drones. Those are the types of devices that Motorola Solutions provides today. Interesting platform to take a look at here right now in a more uncertain world, especially as more and more governments and security is sort of required in a world of significantly higher geopolitical risks. Stocks like Motorola Solutions are the ones that sort of benefit from that type of shift in geopolitical tensions. So, those are some of the ones that I think are worth paying attention to for today's session. Like I said, there's a lot of uncertainty out there right now. Having some protection on your overall portfolio through buying some zero cost collars or buying some put spreads, I think is prudent, as the road ahead is likely going to be filled with some bumps. And having some downside protection in this market makes sense. With VIX back above 21%, also seem prudent to look at option selling strategies such as cover calls, cash secured puts, to generate some income to fuel kind of the buying of downside protection in this type of market environment. So with that, that covers what I wanted to share with you here today. Hopefully this gives you a good background of what's happening right now in the broader markets, what's shifting, and specific opportunities to look at for this week. With that, thank you so much. I hope you guys have a great trading day.